There's a reason why families build wealth quietly that lasts generations, while others hit seven figures and then lose them within a decade. And it's not access, it's not luck, it's not even intelligence. It's how they think and how they allocate, how they make decisions when the market gets noisy. Family offices don't play the game as the same as investors do. And that's exactly why they win. While retail investors are chasing alpha, family offices are engineering resilience. While most people focus on return, they focus on stability, optionality, and control. They think in terms of systems, not just assets, relationships, not just returns, and risk architecture, not just upside. Most retail investors, they're overwhelmed with content, flooded with deal flow, chasing five different strategies at once, because everyone told them you should be diversified. But the wealthiest families I know don't confuse motion with intelligence. They're not trying to be everywhere. They're trying to be right in the few places that matter the most. And what's wild is this. These aren't secrets. Family offices aren't doing something magical. They've just had the time to redefine the way of thinking that most investors are never exposed to. So today, I want to open that door. I'm going to show you what family offices actually know, the principles they follow most retail investors never even hear about. And no, this isn't theory. This is what I live. Because after exiting my business, I built my own family office. Not a fund, not a brand, a true capital allocation platform designed to protect, grow, and steward wealth, not chase headlines. And in that process, changed everything about how I see investing. It taught me how to think slower, say no faster, and build structures that proven even when the market turns. In this episode, we'll go deep on why family offices don't chase returns, they design for durability, why they underwrite people first and numbers second, and why portfolios they build aren't just diversified, they are architected. It's also to share my personal story, a moment when I almost followed the crowd until I remembered what game I was actually playing. And by the end of this episode, you'll have a new lens, not just how to evaluate deals, but how to evaluate yourself as an allocator. Because if you want to build wealth that outlasts you, you can't keep thinking like a retail investor. Let's get started. If there's one principle that separates how family offices invest from how most people invest, it's this. They don't chase return. They engineer resilience. And that sounds simple, but it's everything. Most investors are trained in terms of performance. What's the IRR? What's the cash on cash? How soon do I get paid? But that's always looking up, chasing upside, optimizing for maximum yield. But family offices, they start looking down at the floor. What's the worst case scenario? Not because they're pessimistic, but because they're disciplined. They don't ask, how much could I make if this works? They ask, how bad does it have to get until I lose money? Because they've learned something most people don't realize until it's too late. The most important number in investing is not return. It's your max drawdown. How much can you lose and how fast can you recover? That's the game. Family offices structured their entire portfolios around one core truth. Innovation precedes prosperity. If you lose 50% of your capital, you need 100% back to get to zero. But if you lose only 5, you only need 5.26%. You think the math is boring? Family offices think the math is everything. That's why they build portfolios that bend but don't break. They use preferred equity, structured debt, capital positioning, and discipline sponsored relationships. They're not in love with yield, they're in love with durability. Let me give you an example. Last year, we reviewed two nearly identical multifamily deals in the same state, same vintage, and identical projected IRR, which was 16%. One was structured as common equity, the other was preferred equity with a fixed return of 9% capped upside and seniority in the waterfall. Most investors would have picked a 16% equity deal because it looked like more. We went with preferred. Why? Because it had 4 layers of downside protection. sponsor co-investment, interest reserve, and hard exit triggers. The retail investor is asking, how much can I make? The family office mindset is asking, how do I structure this so I can't lose? That's resilience. And when the market softens, and it will, that's what the thinking that survives. Now, let me take this even further. Most people confuse volatility with risk. They think that if something feels risky, it is, or if it feels stable, it's safe. But real risk is what you don't know what's coming. It's what happens when your assumptions break. It's when a refinance doesn't clear, when cap rates expand, when liquidity disappears. Family offices are obsessed with building around that. That's why they keep dry powder, why they stress test deals under multiple scenarios. While they're willing to take a 9% return, they understand over a 15% built on hope. Because they've already seen what happens when things go sideways, and they've already made peace with a fact that wealth is built on staying power. That's the part no one talks about. Everyone's trying to win big, but the best investors, they're trying to not lose big. They want to stay in the game year after year, cycle after cycle, because if you can keep playing, you don't have to be brilliant. You just have to be consistent. So here's my challenge to you. The next time you're evaluating a deal, don't start with IRR. Start with the risk stack. Ask, where do I sit in the capital stack? What assumptions are being made about exits, rent growth, and debt markets? What happens if it takes 12 months longer than expected? What if it underperforms by 20%? And then ask yourself, would I still be okay? If the answer is yes, you might have something. If the answer is no, it's not resilience, it's roulette. You want to think like a family office? Build your portfolio about what happens if everything goes wrong. And when it does go well, then just that's bonus for the disciplined. Let's keep going. In the next part, we want to look at one of the most counterintuitive things family offices do better than almost anyone else. They underwrite people first and projections second. Because the spreadsheet can say anything, but the person behind the deal, that's what actually drives the outcome. Let's talk about it. There's a line I've heard over and over again of investors saying for decades. They say, don't invest in deals, I invest in people. Now, that sounds like something you put on a coffee mug. But for family offices, it's discipline, and it's a serious one. Because they've learned the hard way. The spreadsheet never makes the decisions, the sponsor does. And that means it doesn't matter how good the IRR looks. If the operator lacks integrity, focus, or maturity, that IRR is just decoration. Family offices are obsessed with sponsor quality because they know the real estate is not passive. It's not an autopilot, and it's not just buy and wait execution. Day in and day out, and who you partner with is the difference between a boring win and a catastrophic loss. Most retail investors, they fall in love with the numbers. They get impressed by pitch decks. They assume competence because the deal looks sharp. But family offices dig. They do background checks. They call past partners. They ask uncomfortable questions. And most importantly, they watch how sponsors respond when they're challenged. Let me give you an example. We once passed on a deal when the deal itself was fine. It was the sponsor that raised the red flag. They had great track record on paper, plenty of social proof, nice office, strong brand, but on the diligence call, every answer was polished and vague. I asked, what's one of your projections went wrong and how did you respond? And they said, we've been pretty accurate so far. I pressed and I asked, what's your worst performing asset? They said that they do things differently. What lessons they learned, they dodged it. And in that moment, I knew this person wasn't humble enough to hold capital through a storm. They were still trying to look smart, not be transparent. That was a hard pass. Because when things go wrong, and they will, you don't need a storyteller. You need a strategist, someone who can make hard decisions, own up to mistakes, communicate early and clearly, and protect investors' capital like it's their own. Family offices don't just underwrite track records, they underwrite character, they underwrite communication style, they underwrite emotional maturity. They often pass on higher returns if it means investing with someone who's already proven they can navigate a downturn. Because here's one thing no one tells you. Your sponsor is your first line of defense and your greatest point of failure. And if you don't know how to vet them properly, you're not investing, you're outsourcing. Now, what does it mean to underwrite a sponsor well? It means asking real questions like, how do you personally make money in this deal? And when? What's the last time you had to pause distributions and how did you handle it? What do you do when investors push back? What are you not good at and who covers them on your team? It also means watching what they say and don't say, how they handle friction, whether they follow through on the first call, whether their team is prepared or just polished. Because here's one family office understand intuitively. Most deals don't fail because of the asset, they fail because of the ego, sloppiness, or silence. So when you're allocating capital, especially into private markets, you need to make peace with one truth. You're not buying the deal, you're marrying the operator. And if you wouldn't trust them to manage your capital during a market correction, you shouldn't be handling them your money during a bull market. At Infinity 9, this is a non-negotiable. We've passed on plenty of great deals because the sponsor didn't pass the people test. Because long-term wealth isn't about finding great opportunities. It's about building great partnerships with people you trust. People who tell the truth, who communicate in real time, and who take the hard road when it protects investor capital. Let me close this idea with something personal. I've had deals that underperformed, but I never lost sleep because the sponsor called me first. They explained the issue, they laid out the plan, and then they executed. I've also had deals look fine on paper, but the sponsor went dark when moment things got hard. Same IRR on the pitch deck, completely different outcome in real life. So here's the takeaway. If you want to think like a family office, stop looking at the pro forma. Start looking at the person behind it. Because spreadsheets can't make decisions, but people will. And when you get the people part right, you protect your peace. Let's keep going on the next part, and I'll show you how family offices don't build portfolios like collectors. They build them like architects. Clear structure, defined roles, everything with a purpose. And that mindset, it changes everything. Most retail investors build portfolios like collectors, and a little of this, a little of that, some multifamily, a bit of crypto, a bit of stocks, maybe a GP's friend's deal, maybe a self-storage fund from a webinar. They're constantly picking up pieces, adding exposure, diversifying, and collecting assets like they're filing them on a shelf. And on the surface, it looks productive, it looks like momentum, but under the hood, it's chaotic. Because most of it isn't built around a plan. It's built around opportunity, around what came in the inbox last, or who pitched the hardest, or what looks safe on YouTube this month. Family offices don't build like that. They don't collect assets. They architect portfolios. Every position has a reason, every asset has a defined role, every investment serves a larger structure. Think of it like this. If you were a retail investor, what role does this deal play in the broader capital strategy? Most of the time, you'll get a blank stare. If you ask the family office the same thing, they tell you exactly, this is stable cash flow sleeve. This is long duration growth. No liquidity needed for 7 years. This suits junior in the stack, but I've been capped exposure to 5% of the NAV. That's how we know that every position exists. And more importantly, they know how they would exit them, shift down or double down. It's architecture. It's clear, intentional, and load bearing. And here's the mindset shift I want you to make. Your capital deserves more than diversification. It deserves a blueprint. Let me break this down. Family offices typically build across 3 strategic zones. Stability. These are income generating, low volatility positions. Think preferred equity, senior debt, triple net retail. The goal here isn't to get rich, it's to stay liquid, stay safe, and cover baseline needs. Growth, this is where you take calculated bets, development deals, common equity in strong markets, private equity, or operating businesses. You underwrite for your upside, but with clear limits and guardrails. And finally, you have optionality. This is dry powder, opportunistic capital, the ability to say yes when others can't. Family offices don't want to be in the fully deployed, they want to be strategically available. And in that third bucket, that's where most retail investors completely miss. They think the goal is to always be fully invested, but family offices know dry powder is not dead capital. It's your seat at the table when the market dislocates. That's architecture. Now, what happens when you start thinking like that? Instead of thinking, is this deal good? You start asking, does this deal fit? It's a big difference because some deals come along all the time. But a deal that fits in your structure, that protects your downside, enhances your yield, or fills a strategic gap, that's rare. So what does that look like in practice? Let me give you an example. A client came to us selling a business, roughly $10 million to deploy. Before we touched a single investment, we spent 2 weeks mapping out their liquidity needs, their tax strategy, even their psychological risk tolerance, and the legacy goals they had for their family. Then we designed a capital stack, not a list of deals, a stack strategy. 35% into structured income with defined distributions, 20% into long-term hold value add real estate, 15% into private credit, 10% into venture capital, and it was capped and contained, and 20% held back for opportunistic pivots. We knew the role of each dollar, how long it would be deployed, when it would come back, and what would we do if the market moved. That's not collection, that's construction. And the impact, 2 years later, he's not chasing deals, he's evaluating fits. He's not stressed about volatility, he's structured for it. And he's not relying on hope, he's operating from design. That's the level I want you to get to. Because once you shift from collector to architect, everything changes. You stop asking, what's the return? And you start asking, what does this piece do for me in the bigger picture? You stop being reactive. You start being strategic. You stop being impressed with what others own or what you own. You start building peace through what you understand. Family offices don't build fast. They build right. And you don't need to have $100 million to think like that. You just need a plan, a framework, and the discipline to follow it when everyone else is chasing the next shiny thing. So here's the takeaway. Start treating your portfolio like a blueprint, not a basket. And you'll start making decisions that last longer than any bull run ever will. Let's close this out with the next part, and I'll share a personal moment when I finally started thinking like a family office, and what changed the moment I stopped collecting deals and started building something durable. It didn't happen at once. There wasn't one dramatic moment when I suddenly thought, oh, now I think like a family office. It came slowly, through frustration, through stress, through moments where I looked at my portfolio and thought, what exactly am I doing? I remember one deal in particular. It was a multi-family syndication with big returns in a strong market and a sponsor I liked. So I said yes, and at the time it felt strategic. But when I looked back years later, I realized that I had no idea why it, beyond the surface numbers, was part of my system. It wasn't solving a capital need, it wasn't balanced by anything else I owned. It was just another deal. And then I looked at everything else that I was in. Some preferred equity here, a startup over there, a couple of development deals in completely unrelated markets. And it hit me. I don't have a portfolio. I have a pile. I have a pile of decisions, a pile of strategies, a pile of assumptions with no architecture to hold them together. And that's when I stopped. I cleared my calendar, I paused the new deal flow, and I asked myself the question I know ask every investor I work with. What game am I actually playing? Is this about income, legacy, freedom, conviction, security? Because if I don't know the purpose behind the allocation, then I'm doing is reacting. That was the turning point. It's when I started building my own family office, not as a status symbol, but as a way I finally think clearly. To see capital not just as a trophy, but a tool. To stop chasing opportunity and start executing a plan. Since then, I've said no to deals I would have chased 5 years ago. I walked away from complexity. I've cut relationships that look great on paper but didn't meet the new standard. And most importantly, I've built peace, not just cash flow, not just performance, peace. Because once your capital is aligned with your purpose, you stop trying to prove anything. You just build quietly, deliberately, like an architect. So here's what I want you to take away from this episode. You don't need $100 million to think like a family office. You don't need staff or a vintage family crest or a leather bound balance sheet. You just need to a shift from reacting to designing, from collecting to building a structure, from chasing returns to engineering durability. Because that's what family offices know and what most investors never learned. The game isn't about how much you can make, it's about how well you can think over time, across cycles, through uncertainty. That's the edge. Family offices protect the downside first. They underwrite people before projections. They don't just diversify, they assign roles to every asset. They move slow, they say no more than yes, and they always build longevity over popularity. But most importantly, they invest in stewards, not speculators. And that's what I want for you. Not just more assets, but more alignment. Not just capital that grows, but capital that compounds with intention toward the future you actually want. So here's my invitation. Take a day, step back, look at everything you're in, and ask, why did I say yes to this? What role does this play? What happens if it doesn't perform? Would I allocate this way again if I had to start all over again? These questions are the beginning of clarity. And once you have clarity, you can stop collecting. You can start building. And you can start thinking like families who stay wealthy quietly for generations. If this episode gave you that pause, that wait, I've been thinking about this all wrong moment, good. That means that it's working. If you want more, that's what we're here to do every week, to teach real capital discipline. One decision, one mindset shift, one better framework at a time. No pitch, no hype, just stewardship. Because that's the game. And now you're playing in it.